Let us examine how to identify potential high growth stocks for capital appreciation. How to identify potential high growth stocks for capital appreciation. So in this video, I want to start with the introduction to identifying growth stocks. Introduction to identifying growth stocks. Number one, growth stocks are companies expected to grow at an above average rate, offering high potential for capital appreciation. Identifying these stocks, involve looking for companies with strong growth prospects, innovative products or services, and a competitive edge. There must be a moat around the company, as the case may be. Number two, key indicators of growth potentials. Key indicators of growth potentials. So there's revenue and earning growth. Revenue and earning growth. So look for companies with consistent revenue and earning growth over the past few years. So high growth in both, factors indicate strong business performance. So there's strong future projection, strong future projections. Companies with analyst projections of continued strong growth based on their business models, product pipeline or market demand. Watch and listen carefully to analysts and projection. If analysts, projection indicates that the company will continue to grow because of its innovative offerings and strong, earnings, then of course, and that's how to identify a typical growth stocks. So there's innovative products and or services. So in this case, growth stocks often have unique or cutting-edge products that drives demand, such as tech advancement or disruptive business model. It's just like people queuing up, long queue in Apple stores to get the latest iPhone, as a typical example of a growth company. So market share expansion. So companies that are increasing their market shares in a growing industry are more likely to continue expanding their revenue and profits if the company is able to take market shares continually and continue to expand. That company is has growth potentials and could be classified as a growth stock. Number three, financial metrics to look for. What are the financial metrics you should look out for to indicate whether the company is a growth stock or has a high potential for capital appreciation? So in this case, you consider, high revenue growth rates. High revenue growth rates. So a high revenue, growth rate, example, something like 20% and above, is a strong indicator of potential growth. 20% and above indicates that the company has the tendency to grow faster. There's earning per share growth. Earning per share growth. So look for companies with strong earning per shares, showing that they can grow, profit faster than competition. So consider the earning per share. If it is growing at a higher clip, then of course that company will perform better than the competition. You also consider return on equity. Return on equity. So high return on equity indicates that the company is effectively utilizing, shareholders' equity to generate profits. So a good sign of strong management and growth potential. The management is a very strong one. They are doing very well. Then they utilize company's equity, shareholders' equity to generate profits. And that will then also indicate, strong growth potentials. Then there's low debt level. High level of debts can hinder growth. So to consider, companies with so you need to consider companies with manageable or lower debt to equity ratios. It must not have high debts. The debt should be quite low compared to its cash flow and the equity. Number 4, industry and market trends. Industry and market trends. Sorry. Industry and market trends. Imagine industries, favorable market conditions and competitive advantages are what need to be considered. Look at emerging industries. Look at favorable market conditions like investor sentiment favoring the company. Look at its competitive advantage. Does it have a moat around it? This company usually have a moat around them. And then you look at stock price valuation. Stock price valuation. Number 5 is stock price valuation. In this case, you look at price to earning ratios. You consider price to earning ratios. So growth stocks, often have high PE ratios when than their than value stocks due to their expected growth due to growth expectation. So investors are willing to pay a higher amount of money for each dollar generated because of the expected growth rates. So a higher PE ratios is common, but it should be justified by the company's growth prospects. That is it. How is the company's growth prospects? If it is expected to grow very fast, then the high PE ratio is justified. If not, then one should not pay extra dollar for the growth prospect that may not materialize. Then you look at price to sales ratio. Consider price to sales ratio. For comparison with for companies with little or no earnings, the price to sales ratio can be a useful metrics. In the case where the company isn't generating profits, so PE ratio may not be relevant, may be meaningless, so you consider price to sales ratio. So a high price to sales indicates strong growth potentials, but be cautious of overvalued stocks. Be cautious of overvaluation. Then number 7, risk to watch for. What are the inherent risks you should watch out for? You watch out for overvaluation. Be wary of growth stocks that are priced too high, as they may have limited room for further appreciation because the company will not grow to the sky. If you buy at a point where it is getting to overvalued, you may end up losing your money when the market corrects. So you look at a market volatility. Watch out for market volatility. So growth stocks are often more volatile and can be significantly impacted by market downturns because they are volatile. In an event where the economy nosedives and there's a market downturn, then growth stocks will suffer the most compared to value stocks.